Alrighty guys, so in this video let's talk about the ICT time-based setups. Right, a lot of people ask me about macro, silver bullet. We're going to merge all these things together today, and hopefully by the end of today you'll have an understanding of how you can use time, because there are so many different ways you can use time. You can use macro, silver bullet windows, opening times. You can also use potentially kill zones, which we'll talk about. But it's something that I really think is important, because other things like different PDRAs, or what do people class as Asian session, or what's a market structure shift, everyone has a different opinion, which is fine. But time you can't change, right? If someone says, look for this at this time, or expect this at this time, you can't change that. Time is always ticking, time is always there. So I do like it because it's more objective rather than subjective. And it's something that a lot of people can refer to when they're looking at the price action or the charts, right? So looking just here, I've just outlined a few, key sessions. In grey, that is the Asian session. Here you've got the London Open session, 2 to 5 in the morning. And here is the New York AM session, which for me I'd class as 9:30 till 12. So just so you know, I've outlined these key sessions. And for the purposes of this video, this is what I'm referring to as the Asian session, London Open session, and also the New York AM session. And again, within these kill zones, we can narrow down time to find those high probability setups. So a lot of people talk about, okay, look for something in silver bullet, or look for something between 2 to 5, but that's such a long time frame, right? So today, hopefully I can narrow down for you different time frames you can personally look at, different ways you can approach it. If you're happy to wait there for 3 hours, great. If you want to focus on 1 hour, cool. If you want to focus on 20 to 30 minute intervals, even better. So we're going to talk about all those things today, and include some talk about macros too, which I personally use. So let's get straight into it. So firstly, just talking about the London Open session itself, I've denoted the London Open session between these two lines here. So if you go back in this previous example, you can see that in blue. I've now denoted that here between these two black lines. We've taken like a zoomed in picture of this session, and this is on the 1 minute time frame. So within this session itself, there's often going to be multiple opportunities, right? Some are going to be long, some are going to be short. And I've started to mark out different opportunities to go long and short. So for example, we've got an inversion fair value gap here. We've got a sell side imbalance. Price uses that to move lower. We come up again, we sweep liquidity. We go down, we sweep liquidity. We have a shift, an order block, we push higher. Is one of these setups, or are one of these setups better than the other? No, right? Because how I personally trade, I'd be happy to take longs or shorts in any session. I'm looking for the nearby draw on liquidity. So for me, without a bias and having a narrative of where price should trade for the next 30 minutes, that makes things a lot more simplistic, because for number one, I don't miss out on setups because I'm marrying a bias. And number two, I'm flying with what the market's giving me, because if your bias is wrong and all you have is, say a long bias, for one, you're not taking shorts. And for two, if there's a setup to go long that really isn't a setup, you're going to take it anyway, right? So for me personally, I trade even narrower than what you see here, but it's just to illustrate the fact that during the whole session, there's going to be many setups, right? So when you're talking about time, the first thing obviously is to separate price action into key sessions. Asian session, London Open, New York AM, New York PM, lunch session, and the list goes on, right? So that's the first thing. The second thing now is we can actually narrow down that same time frame between these two black lines into like a silver bullet session. That's important. So I've denoted the silver bullet window from 3 to 4, right? So 3 to 4. This line here is 3. That line there is 4. So for some people, they don't want to be looking at the charts for 3 hours. And I understand that, right? You got a life, or you got work, or you got something else to do. So a lot of people want to narrow down their time frames to silver bullet. And people ask me, I'll say, well, is there going to be a setup every single day in silver bullet that is extremely clean? And the answer to that is no. Is there going to be a setup every silver bullet? Potentially, but is it going to be a clean setup? No, right? So for people that are out there saying that every silver bullet's going to be great, it's not the case. If you look at the charts and you go back and you look at even the New York silver bullet or the London silver bullet, sometimes price action's better before, sometimes it's good in the session, sometimes it's good after, and it's up to you to determine what is good price action and what is bad price action. And we'll talk about that potentially in another video. So if you want a video on how to determine if the conditions are going to be good or bad, or what you're looking for, let me know, right? Let me know, and I'll tell you some of the highest probability setups you can use. And some situations where price does nothing and you can find to a really narrow range, it makes it really hard to take trades, right? You might have seen it with the New York session or London session where silver bullet just stays like in a range. It's very hard to decide which way price is going, and you can get chopped up, right? So just keep that in mind. But this gives you a window of time that's only 1 hour. So normally, like the London Open session is a 3-hour period, 2 a.m. to 5 a.m. Now this cuts this down into a 1 hour period, which is even better, right? So you save time. Looking here, right? Looking here. Let's take this a step further. So on the previous diagram, we had this inversion fair value gap. We also had this sell side imbalance. Let's take this a step further, talk about potential setups during this silver bullet window. You can see here, I've defined a range. Now I do have another video on dealing ranges and using ranges and price actions. That's coming soon. But I've defined a range here from this swing high at the top to this swing low. I've then marked out my OTE range. I've marked out my silver bullet window. And notice that during that silver bullet window, during that OTE range, we sweep liquidity. This is one of the best setups, right? We sweep buy side liquidity and we tap into a PD array that was generated previously, still within the London Open session, right? So we form this inversion in the London Open session, we sweep liquidity and tap into OTE during the silver bullet. And you could use that in itself to go short to take out this sell side, right? All these swing lows here are low resistance. Why? Because they're higher than one another. And that's why price aggressively trades like this. Now, a lot of people are saying here, like, is that enough? Like, is that trade from here to here enough? And the answer that I have to that is yes. I think when you get caught up with demanding too much, that's when things go wrong. Because maybe you've got Asian session lows all the way down here. And you're like, yeah, for sure, we're taking out Asian session lows. And you don't take any partials or profits, that's when things go wrong. And that's when break even happens again. Because realistically, most people in the trading game to learn a skill, to implement that skill, and to make money. So why leave money on the table when there's a good target right here? For me personally, London session, if that was 10 handles, I'm taking it, I'm done. If that's 15 handles, I'd probably take partials here. And if I want to hold a runner, I'll take it, right? Similarly, right, we'll talk about this upwards move potentially here. 10 handles, if that's 10 handles, take it, right? We'll talk about how these things can happen, how you can phrase those high probability trades. And that's all I'm talking about here, right? Sweeping liquidity in a zone of OT itself might not be enough. But now we're in a key, time frame, which is silver bullet, and we expect price to move or to spool in this time frame. That increases the probability by just a bit. So the way to see it is you've got obviously this massive window, which is, from 2 o'clock in the morning to 5 o'clock. That's London Open. You've got a narrowed time frame, which is silver bullet, but you have smaller time frames called macros, which we're going to talk about in just a second. But I think this is an important thing to, narrow down and focus on, because, if you just want to trade for 1 hour a day and you can't come back in different segments, the silver bullet's probably going to be the best thing for you. But in saying that, guys, you could trade any of these fragments. Like, we've kind of separated this into 3 fragments, right? You got this fragment here, you got this fragment here, and then this fragment here. 1, 2, 3. Yes, silver bullet's great, but look at price action in this last segment. Isn't there a setup to go long right here? There is, right? So I wouldn't be too concerned about this, right? Say, for example, you work or you can't trade silver bullet. Choose an hour within London Open session and focus on that. Use liquidity, for example. This is another time-based thing. Use liquidity generated in the silver bullet session to target if you're trading outside of that. So, for example, here, if you can't trade silver bullet, maybe you work, right? And it's outside your time zone if you're from Australia or from a different country. But maybe you can trade here. Use the liquidity or the highs and lows in silver bullet to give you a narrative. We've just swept sell side. We've had a shift in structure and order block. We return to that. We can go long. Where can you target? You can target the highs or lows generated in the previous session, which could be in a macro or could be in silver bullets. So I think now we're going to talk about these 20-minute intervals called macros. Now, I just want to phrase this, and I'm going to make it nice and short and sweet. There is a macro every single hour, 10 minutes before and 10 minutes after, right? This is what I trade, right? I trade this mix of silver bullet, mix of the London Open, but I, predominantly trade macros. Why? Because it's such a narrow time frame, and I'm able to zone in and focus around that time frame. That's really important. And what I've done here in the chart, I've actually labeled the different macros. So between these 2 black dotted lines, right, between this line and this line, that there is the London Open session. These macros, there's 4, right? Just in the London Open session. If you're trading the New York session, for example, you've got multiple, right? 950 to 1010, etc., etc. These are the ones for the London Open session. Now, before we get any further, is one better than the other? No, right? Yes, you could trade these because these sit around the silver bullet model, but sometimes price action is going to be good here. Other times it's going to be good down here. It just depends on what's happened the previous day, the previous session. Is there any news? What has price printed, right? These are all things that you've got to consider to make and to phrase those high probability setups when you're using macros, or even when you're trading like a silver bullet model. That's really important to keep in mind. So let's take a deeper dive actually at this macro here, right? We're just going to pick one. We're just going to pick one macro. So taking a deeper dive now at the macro, this is what we see here. Now, this green line and this green line represents this part here. And what we've done now, we've actually zoomed in, I believe, into a smaller time frame. I believe this is the 30-second, and this here is the 1 minute. Right, and I'd encourage you to back test this and forward test this as well. So have a little bit of a look, right? We've got a few PDRAs that I've marked here, and I've denoted obviously the 450 to 510 macro. We can see like multiple price signatures. So number one, we've got an order block. Number two, we've got a sell side imbalance. Number three, we've got multiple inversion fair value gaps, which I've marked out here. And these are all things, right, that take the price lower. But we're going to get into how you can use this then to phrase a high probability trade. So again, you're starting, right, from the key session itself, which is London Open. You can narrow that down into a 1 hour period, which could be silver bullet. Or you could trade the first hour or the last hour. So the session itself is a whole session. You can break it into thirds. You can trade those thirds individually, or you can just focus on a silver bullet session, or you can actually trade in the macros. Whatever works for you, right? So for me, I like macros because they're short windows, but I'll personally sit the whole session if I have to wait for a setup. It just depends on your own circumstances, right? So I think a lot of people feel limited, maybe based on work or, personal commitments, but you can trade any time in that session, right? As long as there's a setup that fits your model and fits your criteria. That's really important to keep in mind. So again, we've got the order block. We've got a massive displacement candle here. We trade back into the order block once, into the order block twice. And the first time we actually disrespect this sell side imbalance. A lot of people might be curious. They go, well, Ruben, why do we disrespect it? Shouldn't we close within? Yeah, we should. But there is the potential, right, for price to always trade up if there's an order block, or in the opposite direction, right? So if we're moving up instead of down and there's an order block below the fair value gap, it is permissible for price to trade into that. You just want to see price use that as some kind of ceiling. That's important to keep in mind. So we mentioned that here. We create the sell side imbalance. We create the market structure shift, which technically could be considered right here. That's your shift in structure. And then we trade back into the CIBI. This second time we trade back into it, this is a good price signature. We don't close up here again. We close in the imbalance. And then notice what happens with here. Look, we create an inversion fair value gap. So you've got paired confluences here. You've got nested PDRAs here. You've got nested, confirmations here. So let's list these all down, right? So you understand what goes into a trade when I'm trying to take a trade, and how you can have all these things that you can go tick, 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 high probability, high, 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 high versus low, 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 low. So number one, we are in London Open session. Number two, right, we're in a macro. Number three, we have 1, 2, 3 PDRAs now created as soon as we create this inversion fair value gap, right? So this here, to be honest with you, that entry there from this inversion, in my opinion, is the highest probability trade setup out of this whole segment. Why? Because number one, we're quite high up in the move still. Number two, we already have the order block and we already have the CIBI. And now we have an inversion. So we're starting to disrespect bullish PDRAs and respect bearish PDRAs during a macro. That's important, right? So that's what I've talked about here. Right, I've marked out the inversion fair value gap, and it's the highest probability setup. So I personally, if you're looking for what I do personally, I trade within macros. Why do I trade within macros? Because price usually does important things there. But here's the thing, not every macro is tradable. Right, so yes, price is algorithmic. Yes, it's bulls in his macros sometimes, but it doesn't always do that. So you've got to have the discipline to sit down and wait and go, wait a sec, am I seeing what I need to see in this time frame? Even if you trade silver bullet, are you seeing the price signatures that you need to see? If the answer is no, there's no trade. If the answer is yes, then there is a trade. So you can make it mechanical in that sense, but in terms of how I enter, what PDRAs I enter from, that's varied for me. So I'm very mechanical in terms of when I'm looking for things, but what I'm willing to answer off can change. I'm happy to answer off a BPR, an inversion, a sell side imbalance, a unicorn model, a total soup, an order block. It just depends what's there, right? So I'm not going to demand the market give me a CB, or a fair value gap every single time. I'm not going to demand the market always return to an inversion because it won't always do that. But I'm willing to execute off any PD rate as long as I've got a clear drawn liquidity. That's important to keep in mind there. So again, we've talked about all that. And I want to just extend that a little bit further because these price signatures, right? It's not just that, right? When you're watching price, whether it's in a macro or silver bullet, charting things out, even if you're not trading, is important because you get to see things repeat, repeat, and repeat. So what I want to focus on now, we've talked about this top segment here. I want to focus on this bottom segment, this orange box, and then this red box here. So if we take a further look at price signatures, have a little bit of a look, right? So we've got an inversion fair value gap marked out in orange. We've got a sell side imbalance marked out here in red. Now the question is this, right? We've come down, we've come down, we've come down. We've displaced through this, bullish gap. It becomes inverted. Why would I not want price to come up here? Why? Well, because all these highs are low resistance. So if I'm still inside with the market and price is still going to move lower, it makes more sense that, look at what it does. Look at what it does here. Look. Does this little run up here look promising that we want to move higher? No. Look at this. We just have this small accumulation run up. That's all low resistance. We tap back into this CB. We tap back into this inversion. In doing so, we actually sweep this swing high. So we sweep that. And look at how aggressively we displaced lower. Perfect. That is a key price signature that you're looking for. So if you're already initiated in a move and price has already started moving lower, moving higher, and then you form this like slow little run up in price like this, you do not want price to come all the way back up here. You do not want that. You want price to aggressively trade below, and after an accumulation phase, you want expansion in the same direction that price has already developed in. So I'll repeat that if you're taking notes, right? When the trade has already initiated order flow, in this case bearish, and you're halfway down in the move, and you have this little rally up, accumulation rally up into an imbalance, PD rate above that, you do not want price to expand higher, you want price to expand lower. Write that down, really important, right? So that's a key thing that I'm looking for. And that's exactly what we're talking about here. The move down has already been initiated. That's the important thing. So any small retracements that create low resistance liquidity, they're fake moves. Like this move up here is a fake move. If price were, to come up like this, I'd expect it to aggressively trade lower. If we don't, and we disrespect PD rays, then I'm anticipating higher prices. So this is how I read price action to know if I'm still inside, and it makes it easier to navigate price action if you understand this, right? So it's more than just entering. A big part is, okay, if I'm still in the trade, if I'm still holding onto a runner, what am I looking for? What should price do? What shouldn't it do? And then based on those things, you can either take partials, close your trade, or mitigate your risk. So that's really important. So hopefully you guys got something from that. That is just solely for the London session and just a few examples of how you can use macros, silver bullet windows, or even the London Open session to phrase those high probability trades. Let's get into some examples now for the New York Open session, right? Or let's call it the New York AM session. So we've done a similar thing here, right? Short and sweet. Between the two black lines is 9:30 to 12. Between the two blue lines is silver bullet. Now again, when you're looking at time, these time frames, they provide windows of opportunity. And it comes down to personal preference. It comes down to how much time you have and also your psychology. For me, right, for me personally, this is important. That's important. Right, so whether you're trading the London session or New York session, you can have great results by taking your small piece of the pie. You don't need price, right? Say you're entering along here, you don't need price to go up here to make profit. You don't need that. Honestly, taking a trade from here, right, to here, it's sufficient. You're looking for something that's consistent, right? I think a lot of people get it wrong, whether they demand a fixed risk to reward, they demand a fixed movement in price. Take price to the low-hanging fruit and see how that goes. See how that changes your trading. If you do that for 4 weeks and you stick to your rules, you'll change, right? Because for me in the past, especially when I started learning, I'd always demand these massive moves. And yes, they're great when they happen, but how bad does it feel when you know that you could have taken profit, but it's the greed now overweighing the fear? right? So for some people, it's fear to enter. Other people, it's greed and holding on for too long. So always pay yourself. Always pay yourself. And that's exactly how I want to start and phrase this New York session, right? So again, if we take a look at that, obviously that's, the whole session there, and that's the silver bullets. Let's take a look at some more examples here. I've now narrowed that down, right? So in between these two black lines, that's silver bullet. These are now our macros, right? These are our macros. So 9:50 to 10:10 and 10:50 to 11:10. So I want to combine all these concepts, but just illustrate to you that it applies in all sessions, guys. So I personally trade the London session, but if you trade New York, it applies there too. So we can talk about it here. So I have discussed this in further detail, this setup in previous lectures. I think it's my last YouTube video. But have a look at what price does here. Right, price comes up, we create a shift in structure, we return back into this bullish gap, which rests in OTE from this low to this high. Then we push up again, we invert this bearish fair value gap, we return back down into that, and then we push higher. Now, for a lot of people, they don't want to take a trade just to here, but this is enough, like I said. So if you use, say, an inversion fair value gap, you can use that to push high and take out this buy side. Now, there's so many ways you can use macros, just so you know. In this case, have a look, right? You can use this macro to enter, right? So we sweep liquidity during the macro, we have an inversion fair value gap, price returns back to it. We can use that macro to enter. That's important, right? So that's 10:50 to 11:10. Enter during the macro, exit outside of the macro, completely fine. This previous macro, what's it do? It actually generates sell side liquidity. So once the liquidity is swept, then we can trade outside of the macro. So I think a lot of people ask me to, like, say you're trading, silver bullet, or say you're trading, macros, or even London Open session. Is it okay to trade a little bit after, a little bit before? Yeah, technically, right? Everyone has their own opinions on that, but when I was trading just solely silver bullet, for example, you're looking for the setup to occur in that time frame, but if it occurs 5 minutes later, it occurs 5 minutes later, right? If it occurs 5 minutes before, it occurs 5 minutes before. It's the same with macros, right? Personally, say with these macros, I'm happy roughly, 5 minutes before, 5 minutes after, give or take. I'm happy, to look for things or to take a setup. Because yes, price is algorithmic, but there's external factors in the market that can influence that too, right? So it's good having a plan, it's good having a checklist, but for me as a discretionary trader, I'm flexible. As long as I see the things I need to see around those time frames, I'm going to execute the trade. As long as I've got a clear draw on liquidity, I'm going to execute that trade. So that's just something to keep in mind, I think, when you're looking at these things. And this is like an A+ example because we're doing a macro, right? We've got all this pre-analysis, right? We've swept liquidity here, we retraced into OTE, we've swept liquidity here, we've had an inversion, we're in a macro, and we've got accumulation to target. So yes, you can enter in a macro, yes, you can enter in silver bullet, but do you have a clear target? That's the final piece of the puzzle, right? The final piece. And lastly, I think it's the last slide here. I want to talk about, key time signatures. All right, so you might have heard people talk about this, maybe not, but I just want to discuss, quickly a few examples of time and how you can use it. So we've talked about sessions, silver bullet windows, and macros. Let's talk about different things now, like opening times and silver bullet times. So as most people know, if you trade the New York session, 9:30 open often has a lot of volatility, right? Price will move. It's the same with news events, right? News will have a lot of volatility, but I encourage you to back test and forward test these times. What are these times? They're important. Start of the London Open, start of London Silver Bullet, start of New York Silver Bullet, AM session Silver Bullet, and PM session Silver Bullet. So in this example below, have a look. We've got all this low resistance sell side. Low, 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 low. Price pushes up, right? We have a typical sweep of liquidity. Now we enter the London Open session. It's not a coincidence that this 2 a.m. candle sweeps liquidity. You can't make that up, right? These are things you're going to see. 2 a.m., 3 a.m., 9:30, 10, 2 o'clock. Back test this, forward test this, right? As I've mentioned here, right? The 2 o'clock candle, which I think I mentioned here, the 2 o'clock candle manipulates price, right? So price pushes up here and we sweep that swing high. Then we start to distribute. So low resistance, we move up, we sweep liquidity, the sell program is initiated. That there is a smart money reversal. And then look at the 3 o'clock candle. Look at it. Look at what we do. Look at the volatility that actually is introduced at 3 o'clock. And this is what I'm talking about here. Look, this massive candle, right? So This initiates the move, this continues the move, and then ultimately look what happens here. We push price down, 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 down. So I wanted to end on this, and I want you guys obviously to do your own research to back test this, forward test this, all these things here. The whole idea is to illustrate the fact that time is a crucial concept. The way you use time is going to be up to you in your own circumstances. Whether you trade macros, silver bullet windows, London open sessions, it's completely up to you. I don't personally believe that one is better than another, but for me personally, I like trading macros just because I'm focused on a smaller window of time. But for me, I'll trade the whole session if I have to, right? Again, if you like these videos, guys, let me know. And if you've made it this far, right? If you've made it this far in the video, I want you guys to comment time in the comments. Comment time just so I know who's still here. And until next time, guys, I'll talk to you then. Peace.